In this video, I will show you my personal top 3 trading tools that can help you eventually to improve your win rates drastically. Now, some of you guys might be questioning that this might not be true. So, I back-tested these trading with these tools many times, and I literally doubled my account in less than 30 days. So, in this video, I would be telling you guys these exact 3 tools that will help you to grow your tiny accounts into massive ones. But first, let me clear you one thing. These tools only work if you strictly follow these 3 rules. Because if you skip these rules, then none of the tools are going to make sense. So first rule is that all of your trades should have at least 1 to 2 risk-to-reward ratio. Means if your stop loss is placed at $50, then your take profit should be minimum at $100, so that you would be profitable even if you lose 60% of the trades. Now, here is a classical example of terrible risk-to-reward trade. Never ever fall to 1 ratio, 1 risk-to-reward ratio trades. Like, if you were going to make $50, then you have to risk $50 too, which is obviously I'm not going to recommend you. Because whenever your win rate slips, you are eventually going to lose big. Now, secondly, if you want to grow faster, then obviously you have to take more risk. If you are not leveraging, then definitely doubling your account in 30 days don't seems to be feasible idea. However, if you follow point number 1, then obviously on every $50 risk, you would be making $100. So even leveraging 2x or 3x would be fruitful to you in long run. Now, third, and by far most important point, is believe in compounding religiously. In my previous back-tested session, I reinvested every possible profit, which helped me to grow aggressively. For example, if risk $50 and you lose a trade, then you lose only $50, but if you win, then you will get $100. Now, if you keep adding wins, then small accounts will grow into massive ones in no time. Now, you are well aware of top 3 trading principles before entering any trade. So now we will discuss briefly about each and every trading tool which are usable yet unnoticed in 2025. First of all, liquidity. But what exactly is liquidity? Well, liquidity is just the untapped order which is pending to be fulfilled by the market. Didn't get it? It's okay. Now pay attention. Imagine if you were a buyer and place a buy order here. Now, what you are doing is you are telling the market that, hello, I am willing to buy you at this price point. Are you willing to come? And if you are a seller and you place a sell order at a particular price, then you tell the market like, hey, will you come to this exact price point in order to fulfill my sell order? Now, most interestingly, market listens. Either buyer or seller, whoever has got stronger investing power in order to fulfill the orders. In simple terms, you are giving the market liquidity if you place a buy or sell order. However, liquidity is placed at almost every price level because there are millions of traders with their pending orders. However, the clusters of pending orders lie at certain point, either a psychological rounded level or any price action level. Now, there is a simple way to figure out liquidity zones in the market. First, go to Google and search liquidity heat map. After that, go and click a site named CoinGlass. This site gives you real-time liquidity zones where most of the pending orders are placed. Like here in BTC chart. You can see bright yellow area. These are clusters of pending orders which market tends to sweep. Now, if you place your take profit here, then it is mostly certain that price will respect your take profit. This is the effective yet most cleanest way to mark liquidity areas and placement of your take profits. Now, our second key tool is drawing trend lines. Trend lines are the most common yet most misunderstood concept in trading. Now the issue is, almost every trader has a different trend line drawing technique. Some people draw by joining the wicks of candles, while others draw trend lines by joining the bodies. Also, we don't know how to respond when price approaches the trend line. Should we wait for price to respect our trend line and bounce back? Or we should wait for a potential breakout? So first, what exactly the concept trend line is? Well, trend line, by definition, is a straight line made after joining different price points of the chart. When we draw a trend line and price is heading towards an upward slope, then we can confirm that price is trending upward, and we can enter and trade accordingly. However, if we draw a trend line projecting downward, then price is heading downward. Seems simple, right? Well, it is not. Well, should you draw a trend line by joining wicks or body? Answer is simple: touch points. Like if wicks touches more than body, then we draw it by joining wicks. Now let's discuss a real-life scenario. Like in this case, if we draw a trend line, then it is passing through the chart, which obviously very wrong to draw. However, if we draw like this, then we can confidently say, yes, I have drawn the trend line. Now let's discuss another real-life scenario. Normally, when price is given a multiple touch trend line, then you normally think this time price will respect the trend line again. However, price gives a breakout and incur you loss if you have entered there. So what's the solution? Well, solution is simple. We use confirmation. For me, confirmation is moving average convergence divergence, famously known as MACD. So whenever MACD gives a crossover at trendline, then this is your signal to take a buy trade and so on. The fair value gap, one of the most reliable tools in trading. However, the issue is newbies are unable to identify the most profitable fair value gap and eventually make decision of entering from a wrong fair value gap, leading to substantial losses. So in this segment, I will guide you how to mark most probable fair value gap and how to plan an entry from that position. First of all, what exactly is fair value gap? Well, it is simpler than it looks. Fair value gap is a formation of a chart where price moves sharply in one direction in such a way that a gap in a candlestick is created. However, it is observed that the gap usually acts as a magnet, and price tends to tap that area in order to fulfill orders placed there. Now, traders know the fact that price will tap that area, so they plan their position accordingly. Now, in order to highlight a fair value gap, you must highlight the famous 3-candle sequence, where high of first candle do not overlap the low of third candle, and the gap formed in between is called a valid fair value gap. Now, the same concept applies to bearish setup too. Always remember the fact that a fair value gap is invalid if there is no gap between first and third candle. Secondly, please make sure that fair value gap remains unmitigated. Now, what do I mean? What I mean is, once price taps to a valid fair value gap, then it would become harsh to trust that fair value gap would work in future. Once you start highlighting the valid fair value gap, then your trading game will elevate significantly. Thanks for watching! If you found this video helpful, make sure to hit that subscribe button so you don't miss any of our price action tips and trading strategies. Leave a comment below with your thoughts, questions, or what you'd like to see next. We love hearing from you. And don't forget to check out our other videos on the channel for more actionable insights, tricks, and techniques to level up your trading game. See you in the next one!